folks, Greg Prado here, Prado Capital Management in White Plains, New York. And today we have with us Paulo Lupescu from Dimensional Fund Advisors, one of the national and global premier investment advisory companies in the world, managing over 650 billion with a B in assets. And we have Apollo back because he's come to our offices in New York and got such great reviews and really was dubbed the master of explaining things, should we say. So again, inflation's on everybody's mind. You know, recently it's popped up. It's going to go through the moon. Everything is going to cost us our last penny in our pocket. But with inflation so much in the news and in investors' minds, how do you suggest investors approach this topic?
Yeah, and it's so interesting because when you look at inflation, it is something that it's presented in the media as sort of the boogeyman that's there to get you. And for sure, if you are a consumer, inflation is not a good thing, because inflation basically means prices are going up. So when prices going up, the same amount of money will not allow us to purchase the same thing. So we can purchase less. So we lose purchasing power in a technical jargon. So inflation is really not good for consumers. And that's why a lot of us dislike inflation. What's interesting, though, is that inflation has been part of our economy for many, many years. And in fact, it's not only that it's been part of it, but it's somehow necessary for the economy to function properly. Because if you think of a consumer, certainly not a good thing for us, prices going up. But if you're a business, let's say you're a farmer and you took out a loan and you have to repay it with interest, well, in order to repay the loan and interest, you actually need to generate a little bit more revenue the following year. So if prices don't grow, you're stuck with the revenue that you had. It's going to make it harder for the businesses to expand. So in that respect, a certain level of inflation is somehow almost beneficial to the economy. And in the long run, Greg, the inflation rate, the price growth in the U.S. from year to year has been an average of about 3%, meaning that if I bought a pair of speakers for my computer last year for $100, this year it would cost me about $103. So it's not unusual, it's not unprecedented. As I said, to some degree, it's desirable. Even the Fed has put a target of about 2% on the inflation for the economy. So just to set the stage, just the word inflation itself, it doesn't have to be that scary. It's been with us, and to some degree, it is necessary. But the numbers that you're hearing right now are not 2 or 3%. They're closer to 7, 8%. And a lot of folks are saying, wait a second, if prices continue to grow at this rate, we're going to be in big trouble. As you said, we're going to spend a lot more money and we're going to be able to buy a lot less. So if you think of this period that we are in right now and what to think about, what to expect from it as a consumer, I'd say that what's interesting is that there are two theories, two narratives, two scenarios that are being put out there by economists and investors for that matter. And one of them is that we're in a transitional phase, that we had this pandemic type of economy, and this pandemic has led to things being harder to make. And then as we transition out of it, we might see a spike in prices, but there's no reason to believe that global economy won't be able to resume producing the way it did, and then the prices are going to flatten out soon enough. And that's the first scenario of a transitional type of price spike, and then we're going to see a flattening. The second scenario is a little more ominous. It's saying not so fast. Consumers are getting used to paying more. Companies are getting used to passing those increases. So as a behavior, from a human perspective, this is not necessarily great, but also, workers are going to demand higher wages. And then when higher wages come around, then prices have to grow to keep up with those. And you have something called a price wage spiral, which is going to lead for inflation to last longer at a higher level. And the issue there is that if inflation stays high and the Federal Reserve tries to do something to reduce it, like it was the case in the 70s and early 80s, then you're going to have perhaps a recession, some economic pain. So those are the two scenarios. And frankly, Greg, as of this date in late March, neither the Fed chairman nor the president of the country, not myself, nor you, nobody in the world knows exactly which one of these scenarios will play out. So it's important to acknowledge them, but also don't listen to any one opinion because it's just an opinion. What I rely on more is the market. We are very big believers in markets. And the market right now has a very powerful signal about what to expect on inflation, let's say over the next 5 or 10 years. And it's not a forecast. It's not an opinion. Greg, it's something that I think of as a referendum. That every single day in the market, investors are basically voting in this referendum with billions and billions and billions of real dollars. And the way they vote is in the way that they price, in the way that they're paying for different types of financial instruments, in particular bonds, some that are kind of hedged to inflation and some that are not. And the difference in price is the clear market signal on the expectation of inflation, let's say over the next 5 years. And that metric is actually being, it's well known among investors. It's actually being watched by the Fed as well. And in fact, I'm going to share with you the live website from the Federal Reserve looking at this metric called the break-even inflation rate. And this is for the 5-year time frame. And just because it's not a household name, Greg, let's just make sure that we know exactly what it is. This value implies what market participants expect inflation to be in the next 5 years on average. So this is, again, it's a market signal. It's a very powerful market signal onto what should we expect over the next 5 years. And if you look back a little bit, what you see is that over the past 5 years, we have had unusually low inflation to the point we barely reached the target that the Fed had set. So it was well below the Fed's target. And when the pandemic hit, we had the opposite concern. Boy, prices are not going to grow. So we really had a different issue just a couple of years ago, exactly 2 years ago. But as the economy reopened, the stimulus kicked in, economy kind of got back on track. The expected inflation over the next 5 years is in the neighborhood of about 3.6%. So what's interesting about this number is that it's higher for certain than we've had over the past 5 years, because the past 5 years have been a bit of an anomaly, way below almost half the historical rate, the historical average, and even below the Fed's own target. So where we are today, it's higher than the previous 5 years, but it doesn't, the market, at least right now, the market signal is that we don't expect that this level of inflation that we have right now to sustain over the next few years. It's just going to be lower. It's a little bit above the historical average, but it's going to be lower than what we see right now. And what's also interesting, Greg, is that this particular referendum takes place every single day. And if you look on a finer, on a smaller time scale, let's say you take the last year, what's fascinating is to see that as information comes in, the expectation of inflation goes up. It went from 2.4 to 2.7, but then it dropped again as information came about supply chains and shipping. And it was the same in the fall. It went from about 2.4 over 3, but then instead of climbing, it just kept dropping and dropping as information came out that is incorporated in this signal. And the last thing that I'll mention about this break-even inflation rate is the day before the invasion. This is the day before the invasion of Ukraine, before the war started. The expected inflation was pretty much spot on the long-term average. And what it appears to be the case is that now that we're about a month into this war is basically costing us as consumers about 0.5% more per year over the next 5 years, assuming that things stay the same. I mean, not assuming, but this is based on the information we have today. As information changes, certainly we're going to see this number adjusting. But as of now, as I said, if you're an investor, if you're a consumer, you're likely going to see prices higher than over the rate of increases in prices higher than over the past 5 years, but it's gonna taper down, at least based on the current market signal. And then you pose the question from an investor perspective: what do you do? And let me touch on three facets that I find interesting for an investor. The first one is how related is inflation to the stock market? Because you hear a lot that inflation is going to really drive the market either up or down. And we wanted to see that, and we wanted to see it not based on an opinion, or just hunches. But when you look at data, what do we see on the relationship of stocks and inflation? Is there a relationship, and does inflation hurt stocks? So when we did this, we looked over the past 30 years or so, and we wanted to explore that relationship. And for the stock market, what we wanted to see not just the returns that they had in that particular year, but returns after you account for inflation. So let's say the market returned 10%, and the inflation was 3%. Well, at that point, the return that you would see, which is called the real return, would be 7%. So this is above and beyond inflation. So we wanted to see the relationship between the market and inflation. So when you plot it as a visual, what you see is quite interesting. These are the S&P one-year returns as a bar, and the yellow dot is the inflation for that particular year. And Greg, if you see here, it's quite interesting because inflation has been quite steady in a way. And you can have a year when inflation is really about the same to another year. And yet one year the market went up significantly, the other one it dropped significantly. So it's not the only time. You have even like here in 2016 and 2017 and 2018, very similar inflation. One year the market goes up, the other one it goes down. So, obviously when you look at this, it doesn't seem to be a clear evidence to suggest that inflation is the main driver of the stock market. In the way that we look at it, inflation is one of the many variables that impact the stock market, but it doesn't appear to be a primary one. It doesn't appear to be the one that it can, absolutely establish a clear link. Inflation is going to do this, the market's going to do something else. We can't really do that. So in that respect, if you are an investor in the stock market and you are concerned about inflation, in reality, we don't really see that as being clearly linked to each other. Even in years of high inflation in the early 80s, you have a year like 1980 or 1981 when the market went up significantly, and we also had high inflation. So you can't really draw a clear distinction and a clear connection. Not distinction, but a clear connection between the inflation and the market. So that's the first thing that I would say from an investor perspective. Don't draw that connection.
This is really great primer on inflation, how it impacts the markets, and really it's how global events can just really throw a little cog in the wheel here. But here's a question for you. Mm-hmm. We're talking about stocks. We're talking about the impact of inflation on stocks. So a lot of folks, they own bonds too. They have what they think is their safe money. So can you kind of walk us through what's the impact to bonds? What's the value of holding bonds in the portfolio? Should we own bonds? I mean, right now, as you probably know, we're coming out of a decade of very low interest rates. Now we have inflation kicking in. We have people that are in bonds that have gotten no growth to them. So they threw their hands up right now. They're going, where do I go? Stocks, bonds, inflation. How do you put it all together for us, Apollo?
Yep. So let me, first of all, absolutely great question. Bonds are part of some people's portfolio, and the reason you have bonds is quite different than the reason you hold stocks. If you think of the stock market, that's your engine of growth. Historically, stocks have provided investors with growth. And if you want to draw an analogy, think of going sailing. You put the sail up, the boat's going to go fast, but it's going to toss you all over the place. And for some people, that's appropriate. That's what they want. But other folks want some stability. It's like, I don't want to go that fast. I just want to make sure that I'm safe, and I'm basically I'm not being tossed around as much. So in that respect, if stocks are like the sail, bonds are like the ballast. They are there to give you some stability, not speed. And in that respect, there has to be a balance between, stocks and bonds for most people. And that's the fundamental trade-off in investing. But bonds, what's interesting about bonds is that even if you look at bonds in different interest rate environments, whether the high interest rate or low interest rate environment, bonds tend to do a really good job in a portfolio because they do not move in lockstep with the stock market. So generally speaking, not in every case, but generally speaking, you see that when the stock market goes in one direction, the bonds might go in the other direction. So you go back 2 years ago, exactly 2 years ago, we had a devastating first quarter as the pandemic began. The stock market, the S&P 500 dropped by almost 20%, 19.6, and a government bond index was actually up quite nicely over the same time frame. So if you go back over the previous 20 plus years, in every single case, when the stock market dropped significantly, this government bond index really held up very, very well. And that's what you want as an investor. You want something that doesn't move in lockstep. And again, there's evidence to say that the bonds have done that, have had that role. It's also possible, though, that when you look at the market just flying high, like in 2013, it's also possible that the bonds might drop a bit in value, and that's fine, because again, what I like is that they don't move in lockstep. So the role of bonds, the way I look at it, Greg, is that they are the ballast. They're not there to make you a lot of money. They're not making you go fast. They're there to slow you down, but give you stability. And for some people who are in their at a time in their life when they need that, that could really do the job. The second comment about bonds is that quite often we refer to bonds as a generic bonds, like all bonds are exactly the same. And it turns out that that is not necessarily the case, that bonds are not all bonds are the same. As an investor, you ought to be very careful about what you consider bonds. So what I mean by that, if you look at bonds, one of the two major delineations, one being credit quality, who's issuing the bonds, and the second one being, how long before you get your money back, which is maturity of the bond, or duration in technical jargon. What's interesting is that makes a big difference. If you look over the past 30 years or so, and the U.S. Bond market, and you ask, in this short-term bonds, which are typically considered 1 to 5 years, how many years did I see negative returns as an investor? Again, we've had rising rates, low rates. What you see is that it's only 1 year in 1994, and you would have lost less than 1%. So in short-term bonds, it doesn't seem to be like a huge hit, even when you have rising rates. But you also have intermediate bonds, which are longer term, beyond 5 years, let's say 5 to 10 years or so. And in this case, instead of 1 year, you have 2 years when you might have lost money. But even then, it's not tremendous. However, even in 94, instead of losing less than 1%, it's a little bit bigger loss now, less than 2%, but still nothing devastating. However, if you look at long-term bonds, the interest rate changes have a bigger impact on these longer-term bonds. And that's because bond prices are driven by math. So now you have, instead of 1 or 2, you now have 5 years of negative returns out of the 31 years. And in 94, instead of 1 or 2, you have a negative 7% drop. So it's important for investors to really delineate and understand, what bonds do I own? Do I own the short-term, intermediate, or long-term? Because your experience, your returns are going to be different for the same level of an interest rate increase. Now, just to put some perspective, that's the bond market. It's still a lot less choppy than the stock market, because if you look at the stock market, you certainly see that you have a negative 37, negative 22, much bigger drops in the stock market. So even a bond bear market in long-term bonds is not really as tough as for an investor as the stock market. So that's on bonds. But the last thing that I would comment on, Greg, is that bonds can also play a fantastic role for folks who are concerned about inflation, because there are different categories of bonds. And one of the, within the government bonds, there's a category that is called Treasury Inflation Protected Securities, or TIPS. And what's fascinating about this is that it probably provides one of the best hedges against inflation. And why is that? Because in the contract, when you lend your money to the government using these tips, what the contract spells out is that if inflation goes up, the value of your bonds goes up to match the increase in inflation. So as inflation goes up, so does the value of your bonds. It moves in lockstep. So that's a great hedge for an investor who is concerned about inflation. You don't need to go to fancy stuff and all that. Tips can provide, for some people who are concerned about hedging inflation, a really fantastic way to hedge inflation. Now, for investors who are not necessarily concerned about everyday hedging, but they say, no, I do have some goals down the road, and I want to make sure that I'm protected, that if, inflation takes keeps going up, whatever the case might be, I do want to make sure that I'm protected. It is important to know at that point, what are the different investments, what are different asset classes, as we know, that might be able to actually outpace inflation over the long run. So not necessarily hedge it every day, but how do we stay ahead of it? Because, let's say, Greg, you are roughly you might be a little younger than I am, but, we have goals that are maybe 10, 15, 20 years down the road. So I'm more interested, like 10, 15, 20 years, what would outpace inflation, even if we have higher inflation years? So what we did is we looked at all the inflation years in the US, starting with the lowest, which happens to be, Greg, 1932. It was a 10% negative inflation, which is called deflation in 32, to the highest, 1946, at about 18%. And we ranked all these years from the highest to the lowest. Then we cut it in half. We discarded the lower half, and we only looked at the above median inflation years. And we wanted to know, after inflation, how do different investments perform? And this is what we found, which is quite interesting. These very, very short-term government bonds that a second ago, they look fantastic because they don't really give you negative returns. When you account for inflation, let's say in T-bills, they don't keep up. After inflation, you are below by about 0.6%. So they're not doing a great job keeping up with inflation. However, the longer term bonds, they give you inflation back plus 0.4 above it. So here you recover inflation and you get a little bit more in these bonds. And then if you want to look at the corporate bonds, you can see that you get a little bit above inflation. You get inflation plus 0.9. And once again, the good news being that there are asset classes, there are investments that over the long run would outpace inflation. In these, again, we're looking at above median inflation years. Now, when you look at the stock market, did a really good job. The stock market did a fantastic job in a way, because on average in these above median inflation years, not only that you got inflation back, but on top of inflation, as an investor, on average, you would have gotten 4.9%. And within the stock market, you have like these companies that are large, mature, well-established, typically associated with large growth. And those also stayed ahead of inflation, not as much, but still ahead of inflation by 4.1. And for investors who want to diversify, and instead of large, they hold small. And instead of growth, they hold value. Small value was also an asset class that seems to, once again, significantly outpace inflation over the long run. So the ultimate story, packaging it all together, is that if you are concerned about hedging inflation, there are some, tips, and there are funds that have these type of securities. If you're concerned about keeping and staying ahead of inflation, the good news is that there's good evidence to suggest that a diversified, balanced allocation, a portfolio, would give you a really good chance to actually outpace inflation over the long run, and stay ahead to make sure that you have your purchasing power when you're ready to achieve your financial goals.
Listen, this has just been a really, really great overview. Because it's really what people are thinking about. And one last question for you, Apollo, because it pops up over the years. It's always popped up. And to be quite frank with you, I've sort of been of the mind as you are that asset allocation, different asset classes, global diversification wins the day. But pops up gold. Tell me quickly, short 5 seconds, 10 seconds on gold and its position that you think it should play in conjunction, or really just not, with a globally diversified portfolio.
To begin with, gold is part of an allocation because there are a lot of mining stocks that have gold. So in that respect, you have gold in your portfolio. The question is, should you hedge inflation or should you have gold separately? And the short answer is I'm very skeptical of it because gold was a good hedge at the time when the U.S. had the gold standard. We moved off the gold standard back in 1971. And since then, the price of gold has fluctuated like this. Prices have fluctuated like this. So it's kind of hard to make an argument that something that fluctuates so wildly should actually be a hedge against something that barely moves. So I'm not a fan of gold for hedging. I think when you look at the data, what you see is that there could be stretches like 25 years between 1980 and 2005 when prices increased 2.5 times. And yet gold might not change in price at all. So gold, neither conceptually nor looking at the data, seems to be a good hedge against inflation. If you want to hedge against inflation, absolutely, I think what we mentioned earlier, tips would be a great one. There are some funds that have an inflation swap, which is at a simple level, it's like an insurance that kicks in and pays off if inflation is high. Those are much, much better ways to hedge against inflation. Gold is a legacy idea. Gold might have made sense up until 1971 when the U.S. severed the link between gold and the dollar. Since then, the dollar had nothing to do with gold. Today, the dollar has nothing to do with gold. But I think a lot of folks remember those days, the gold standard day, and that's fair. That's fair. I just don't think that applies today. It's that train has left the station.
Okay, and then again, only because I just say 5 seconds, and I just had one more thought, because the younger generation is into what?
Crypto,
right? Yeah, I knew it was coming, Paulo. So, and I'm totally agree with gold. It's not been part of my my asset allocation for a long time. But quickly, crypto, it's in the news. It fluctuates, and there's a lot of folks, especially in the last 5-10 years, that feel this may be the new gold.
Yeah. Crypto is an interesting idea. Crypto came along and it really wanted to introduce some ideas that I think are really interesting. And the first thing I'll say about crypto, which is a little more than 5 seconds, but there are two things that all of you folks should consider. One is that there is a technology that it introduced, which is called blockchain. And I do believe that the blockchain technology does have the potential to make a lot of things better. I do think that there are a lot of smart things that can be built on this platform called blockchain. And fundamentally what blockchain means is instead of having a ledger that is controlled by one entity, so your bank right now keeps track of who owns and who owes what money at the bank, this would be a decentralized ledger that is on many, many computers. It's transparent and visible to everybody. So it's the idea of decentralized finance. You don't need to trust anybody because everybody is part of this network. I think blockchain is a really good idea. And I want to separate that from the idea of Bitcoin, which was supposed to be some sort of a currency. And it's not a currency because I don't know about you, Greg, I've never bought anything on Bitcoin. I don't know anybody who has. And it's estimated that a great deal of the transactions in Bitcoin, they're done by ransomware folks and kidnappers and drug dealers. So they're not really used it for legitimate purposes. So it's not a currency. It's just a lot of folks have looked at it as an investment because you can make a lot of money. And it's not an investment in the category of stocks and bonds because stocks, bonds, and real estate, they're productive assets. They produce something and they generate some cash flows. You make some profits if you're a business. If you buy a building, you rent it, you generate rent. And because you have these expected payments to get as a business owner or as a building owner, you can value that. How much is that worth it? And this idea of valuation is crucial to investing. Bitcoin has none of that. Bitcoin is more like buying a baseball card or a bottle of wine or a piece of art and saying, well, this is going to be worth more because somebody else will pay me more in the future. I don't know why. So I'm kind of speculating on this. So to me, the Bitcoin is something that you have to ask yourself very carefully. Why do I want to buy it? And I'm going to tell you there are 3 reasons that I find that people want to buy this. Number one is that it's a social thing. It puts you in a category of people. You find a community there. And it's fun to talk about it. It's something to kind of sell something about who you are as an individual. So I think that might be one reason. The second one is that you draw pleasure from owning that the same way that you draw pleasure from owning a baseball card. Nothing wrong with that. If you make money, great, but at least you derive the pleasure of consuming that or owning that. And the third reason, which I think is so interesting, is because even though nobody understands how Bitcoin works and how it makes money and all that, it has created a dream. There's the dream aspect of it. And Greg, that's powerful. In the US, this is like last time I checked a few years ago, in the US, our citizens, our country was spending more on lottery tickets than it did on milk or beer for that matter. And the reason is because the people wanted to dream. There was a dream associated with that, and there's value. So if you have one of these three things, either because you want to be part of a community, either because you draw pleasure from it, or because you want to dream, then maybe take some of your money a little bit on the side and do it for the right reasons, the same way that you would buy a lottery ticket or a baseball card. If it works out, great. If it doesn't, it should not devastate your portfolio. So Bitcoin right now, I don't see it as being part of a diversified portfolio that would help you achieve your goals. I think it's too risky. I think it's more of a different type of play that you do on your own, not necessarily being part of the portfolio. But if you want to do it, listen, I had an event in Vegas a few weeks ago, and I had breakfast at 6 a.m. and there are so many people still gambling. So who am I to tell them that that's wrong? If that's what you want to do, just do it responsibly, and that's fine. But do separate and do understand that as part of your diversified portfolio, you do have companies that are actually tapping into this blockchain technology, and so you're not missing out on that piece.
Well, that's just really right in the line what we talk about. We're not a big Bitcoin investment firm. And to be frank with you, the process we use, which is a planning-based approach, we need history. We need history in the markets, and we have history with the equity markets, history with the bond markets. Unfortunately, partnering with a firm like Dimensional that understands these different aspects, like you just mentioned, even if you want to get access or a piece of the crypto world, we can do it through things like blockchains and the companies that really will be successful from having be participants in that. But the actual currency itself, like you, we have those exact same conversations with our clients. Unfortunately, they get it. When it's in the news and in your face so much, it's a little easier to understand when you can just boil it down to how does it really help us from a planning perspective to give you the proper tools to say, here's a financial plan. Here's the investments that are part of this plans, and here's why we can trust them because they have history. Okay, so again, Paul, great talking to you. I really appreciate you giving us this time. Great discussion on inflation. I know we'll be back with the next great topic, right? Last time it was heavy duty, was COVID. Fortunately, we're well. We obviously have concerns for those that had issues, but we want to thank you for your time. Real great primer on inflation, and we'll look forward to talking to you next time.
I look forward to our next conversation. Thanks for having me.
Feel free to follow us on social media. We're on Twitter, we're on Facebook, we are on Instagram, and we are on LinkedIn. And as always, you can come to our website at pradocapital.com. Have a great day.